You're about to join Jerry Parker, Moritz Seibert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Hey everyone, and welcome to another edition of the Systematic Investor series, where each week we discuss and debate what's going on in the world of rule-based investing right now. My name is Niels Kostrup-Larsen, and I am, as usual, very excited to welcome Jerry Parker and Moritz Seibert to another round of discussions after what can only be described as another challenging week in the world of trend following, but of course also a challenging week, I think, for a number of alternative investment strategies, and of course a challenging week for the long-only investor in equity. So quite a few things happening right now. Why don't we just jump into it and talk a little bit about what were some of the return drivers and potential changes in trend that we observed this week in the various strategies that we are involved with. Who wants to go first? And hi, by the way, it's good to have you here.
Hi, Niels.
Hello.
Hey. So what happened on your side this week, Jerry? We always start with Moritz, so why don't we change that up this week and start with you and see what was going on in your part of the world, so to speak?
Well, obviously, I was very keen every chance I could get to take a look at what was going on in the stock indexes and how that was going to impact my single stock positions. Since I do trade single stocks only and no indices, I was not short maybe some of the European indices that had sort of looked like more of a downtrend than the U.S., but I did have some single stock that I was short. So not a great exposure on stocks, but still a little painful this week. Some of the laggards tried to rally midweek, but then at the end of the week, some of the worst performing stocks, GE, AT&T, had really bad Fridays. So the dollar hung in there. That was nice. Small positions, short bonds, and those rallied, obviously. And energy, crude, heating oil, unleaded, sold off a little over this week. So diversification was important and will be important going forward. So I had a friend tweet something this week, a little cryptic, that said, I think most investors are afraid of their portfolios. And my response back was, yeah, they should be afraid if it's mostly stocks, long only, passive. They're probably not afraid enough. So bad week for us, but we're in good shape, I think, going forward as it compares to probably less diversified investors.
Yeah, no, I mean, couldn't agree more. We saw a slightly different thing on our side. We actually didn't lose money in equities because, as you suggested, Jerry, we had already gone short the European side in a meaningful way, and overall net exposure in our portfolio is actually net short equities from a few days ago. So that was okay, but where it did hurt was the rally in bonds, because that's been a big area for us in recent months. So, made good money so far this year, but we certainly gave back some of that this week and this month. So a tricky one. And on top of that, certainly energy didn't help with those, corrections continuing. But then, as you say, currencies did okay. And other commodities, I think there's one or two markets that stood out, but I can't remember which ones they were. So overall, another really difficult month in as we get closer to the end of October. Somewhat similar, yet different from February, I would say. Even though the numbers are getting close, but in a different way. But as you say, I mean, this is the transition phase of a systematic portfolio where we will change positions, we will adapt, and we will get ready for the next big moves. And I certainly wouldn't be surprised if this, volatility and the troubles we see in the equity space, if that's not going to continue, for a little while longer. So we'll see about that. What about you, Moritz? How was your week?
Yeah, negative week on my side too. Although not quite as painful as the week before, so that's good.
That's good, yeah.
I guess one of the negative things here really is that the year-to-date performance has now changed into negative territory. Never a nice thing to see, but that is what happened.
But at least it's been a while. It's taken you a while to get down to those numbers. Most of us got there somewhat earlier this year, Moritz. Yeah. So you've done well.
So that has happened, and I mean, kind of funny. Seem to be making P&L in the same kind of markets. Most of the losses were from the bond positions, so short treasuries and those rallied. The dollar provided some stabilization, so we're long the dollar against most of the other currencies, and that was good this week. Losses in the energies and also some losses still in the equities, even though position sizes there are relatively small. But wrapping it up, a negative week.
Yeah, no, absolutely. I mean, in terms of, I know we had talked about when we started this series that we would also try and identify some interesting position changes or trend changes. And I don't know about your side, but as I mentioned on our side, certainly the equity overall exposure did change during the week from long to short. So that's obviously a relatively big change in the sense that it's been a while since we've been overall short in the stocks. But other than that, I did not really notice any bigger changes. I don't know if you had any on your side at all this week.
None that are meaningful.
No,
none that are meaningful. I don't want to get too excited about low equity exposure or shorts, because I remember back a few times where all of a sudden we get where our longs get blown up. We distraught, we go short, we're so happy, and then the market rallies to new highs. So I know that's whatever crap can happen and may end up happening. I'm not a tape reader. We're long-term trend following, and paying attention to daily price action is not something I've found that I'm good at. But it was it was interesting this week to sort of see any big rally just almost immediately be sold, and Dow up 500. All of a sudden, no fear whatsoever. Make it go up 600. That's fine. Just people will just come in and start selling. And then, so that was kind of interesting, the weakness. And it's almost like the algos are out there searching for cracks, and they find them, and regardless of a positive day here and there.
Yeah. No, absolutely. Anything else that caught sort of your attention this week? We've got tweets, we've got questions, but I wanted to also maybe talk about some of the articles. There's obviously quite a few floating around right now. Not many of them are particular positive. One article that I think most of us saw from Mark this week. I just noticed that it had a funny cartoon, because it was a cartoon that said something like, my mother always said it's fine to be wrong, but she never worked at a hedge fund. So I thought that was pretty poignant. That's often the sentiment that we get, that it's not great when we quote unquote are wrong in our positioning. But anyway, what articles caught your attention this week?
Big silence.
Big silence. Yeah.
There were a couple. I enjoyed reading an article about William Eckert, who Jerry obviously knows very well, and about his firm in Chicago and what he's been up to. So, trend following trader like three of us. There were a couple of articles I found on Bloomberg about the performance of CTAs recently. I think one had headlined something with "There's blood in the streets" because CTAs didn't deliver, so to say, in the past 2 or 3 weeks, whereas apparently still many people expect them to produce those magical crisis alpha returns every time the S&P takes a dip. So it hasn't happened. I think that's perfectly fine and normal. Like looking at the systems that I'm looking at, it just behaved exactly in the way I would expect them to behave given the market environment. So there just wasn't that immediate short-term crisis alpha available there. But just maybe one addition to that, and that just, it's probably just my opinion, and I can't really base that on any fact, but having looked at the past, say, 10 days or so of market returns, it seems to me that volatility is back. And this kind of like every time something happens, people buy the dip and things go immediately back up, and it's all very smooth and all very low volatility, back to like this controlled market environment. It felt to me as if there were some cracks in the market in the past, say, 2 weeks, 2 to 3 weeks, where we had a lower, and then there was more pressure. There was more selling pressure. Some of the kind of like, the technical support levels, they didn't hold, and it, fell through that. And we saw that in a couple of markets and some of the individual stock names and the indices. So there seems to be a larger shift happening at the moment compared to, say, February, where it's been a very short-term spike. It washed a few people out, volatility went up, but immediately came back down and we were back to normal.
Yeah, I mean, again, not based on any particular article, but I do a little review every week for our clients. And I was noticing yesterday as I was writing it that when you go back, and it's not trying to make a prediction about what's going to happen, but certainly there's been a couple of years in recent times, if we go back to 2007, if we look at 2013, where there were some really, relatively high monthly losses in the trend following space. And then that was really, that was preceding 2 very, very strong periods, probably the 2 strongest periods we've seen in the last 15 years or so, namely 2008 and 2014. So I just wanted to make that statement to our investors that this is not unusual, first of all, and it's quite often something that we see when there is some kind of transitioning in the markets happening, and that may lead to, as you say, more volatility down the road, et cetera, et cetera. So I've noticed that but in a slightly different way that you're mentioning, Moritz. But I do think it is interesting. I think you mentioned another point which I'd love to debate with you guys, and that is this notion about crisis alpha and that there are definitely forces out there that suggests that CTAs are meant to be there as a hedge every time something happens to the equity markets. And I think that obviously we know that a lot of investors would love if that's what we can do, and some managers can do that to some extent at least. But I do think it's a misunderstanding if they think that that's really what trend following is all about. And I think we need to get away from quote unquote, are we a hedge to equities? My answer to that is no. We're an uncorrelated return stream in our own right. We just happen to do well, generally speaking, when there is a prolonged crisis, and I'm sure that's where the crisis alpha comes from. But crisis alpha doesn't mean a 3-day event or a 5-day event or even a 3-week event, in my opinion. But I do think it's something we have to address more and more often now, and kind of defend what trend following really is about, because it's being sold or promoted in a different light, but it's not the medium to long term systems that I'm familiar with, at least.
I agree.
What have you got?
Yeah, absolutely agree. And I don't even use the word as far as my trading is concerned. And also, what I'm baffled about is what is a crisis actually? I mean, most people seem to equate crisis with a drawdown in the S&P 500, but the S&P 500 or equities, that's just one element of a diversified trend following trading system. So what about if the crisis is in oil, like moving from 140 down to the 30s? Is that a crisis? Apparently it's not a crisis, but it has been, a very good return driver for us. So it only seems to be S&P related, as if that were the only asset we'd be trading, whereas that's just not true.
But isn't it? But Moritz, isn't it just reflecting the fact that, and we know that actually bond markets are even bigger than equity markets, even though a lot of bonds nowadays are bought by central banks, so they're not even out with the public. But I guess it is a reflection that a lot of the investors we deal with, they predominantly own equities, right?
Yeah, that may be true. They also, I think, own a lot of bonds, right? Yeah. But I mean, first of all, the thing is, why is it always a crisis if the S&P goes down? Why is it never a crisis if any of the other markets go down? But okay, let's just accept that, right? So it is the S&P or equity market in general that have a drawdown, and every time that happens, say those markets are down 10%, then we are in that crisis mode. Okay, well, if that move continues for a longer period of time and becomes even larger, then you will expect and you will see our systems take a short position, and hopefully we'll then make money from that position and counter some of the long only equity losses. But it's just not going to be immediate, or would be an extraordinary circumstance, and if a system changed exactly on that point and like as of the next day we're short. I mean, it can happen theoretically or practically also, but it
wouldn't be medium to long term trend following. It could be short term, but it certainly wouldn't be medium to long term if it did.
Yeah, but I mean, you could run a long term system which is very close to changing a position from say long to short, and then at that point, kind of like something happens, and the next day or the day after you're changing your position. I mean, it could happen. It's just not very likely.
You brought up something earlier, Jerry, not in our conversation that we're having right now, but something when we were just getting ready for this, that talked a little bit about, equity returns, equity drawdowns versus CTA returns, CTA drawdowns. Why don't you talk a little bit about that? I thought that was pretty interesting.
Yeah, I think to some degree, not only do CTAs have to explain their performance as it relates to the systems and the markets that they trade and the shorts that they trade, they also have to choose a certain amount of leverage, and very few hedge funds or CTAs are targeting, similar return drawdown that an S&P has historically had, 8% return and a 50+% drawdown. So I think this week, especially, there's headlines that CTAs lost more money than the S&P, and some of that is due to the leverage, and their expected annual return, at least according to all of us, when we do our research and backtesting, would be far greater than 8%. Not an excuse, just kind of an explanation of how the returns can not only not provide crisis alpha in a certain week, but actually be worse, because our expectation of profit and drawdown is looked at over 20 or 30 years of analyzing the markets, and we're coming up with methods and systems and ideas that are going to work and have worked over a long period of time, but not that reliable on a weekly basis.
Yeah, no, I completely agree that definitely you could say many strategies are held up to a very high standard when it comes to that in terms of expected returns, but also expecting to have relatively shallow drawdowns, which is difficult to deliver in the long run. And maybe this is part of the problem, at least this is sort of one of the things that I've been pondering. And that is a lot of these strategies that we know of today, take risk parity and risk premia, et cetera, they haven't really been around for that long, maybe 10, 15 years. So, and in that period of time, and I know we've talked about this on this podcast, before, and last 10 years is really abnormal in terms of the relationship between equities and bonds compared to the very long run. So I'm just worried. I mean, I wouldn't say I'm worried, but I'm wondering whether investors are being set expectations for alternative strategies have been influenced by the fact that a few of these younger strategies have actually done really well, but they've done really well in an unusual environment and over a relatively short period of time, because there is some math behind this, but the longer you go out, you should expect your drawdowns to get bigger. That's how the math works, because there's a higher probability that over a 50-year period you could have a bigger drawdown than over a 3-year period. That's just the way it is. So anyways, I think it's something I guess for the three of us who've been doing this for a while, it's nothing new that every time you have one of these events that we have to play defense a bit and explain our views. And I think luckily, I think a lot of the investors who have been around this space for a while, they understand and they acknowledge it. But we're obviously trying to educate a new bunch of investors to diversify into these strategies, and that obviously is never helpful when you see a period like this and with headlines as we've seen. But speaking of headlines, Jerry, top tweets. Were there any good ones this week? Any new records, perhaps?
New record was set.
Okay.
We talked last week about how I feel like I learn a lot from reading about Howard Marks, who's not a trend follower, quite the opposite, and he has a lot of wisdom, which we talked about last week. And then we have another non-trend follower, non-futures guy talking this week, and this one set a new record. Never had as many retweets and loves as I got on this one from Jeffrey Gunlatch. And I'll just read it. And I pulled this out. This is a quote from him. By far the best investing book is Reminiscences of a Stock Operator. Everything in that book is absolutely true about how markets work, how human nature works, the mistakes people make, the greed that they have, the ways they get themselves in trouble. So I think this is a very popular book. Maybe this is what the search picked up, and people just wanted to show how much they love this book. But also, it's a reoccurring theme with the people who follow me on Twitter. The mechanical trading, the systematic trading that we do, the trend following, most feel is based, the truths of that and why it works are sort of based in human biases and psychology. And it's just people, I believe, saying, I appreciate diversification and systems and trend following, that it helps me avoid these mistakes and greed and other ways of getting ourselves in trouble. So I don't know. What do you think? Am I right?
What do you want, Moritz, to go first? Or
I think everything in that book, just as Jeffrey says, is correct. And I actually have multiple versions of that book here at home in my office. One that I bought myself, and then I told people that I really like it, and got one as a present, and then purchased one that had some special drawings from Edwin Lefebvre when he published it in the newspaper back in the day. So it is one of my favorite books, and a lot in that book is about trend following and emotions and fear and greed and how markets work. And if you came to the conclusion, well, that this is 100 or so years ago, and therefore it's no longer relevant, well, I think it is. Markets, they change and technology changes, and the way people trade with each other, that changes. But at the end of the day, it's still people that do trades, and some of those people make up the markets, and their emotions, their biases, their human attachment to P&L, to money, that doesn't seem to change, and that creates tradable markets.
Yeah, and it's also an interesting source, right? That he talks about, Jeffrey talks about this book, right? Because I guess it's well known within our industry, and it's been a while since I read it myself, but I agree it's a great read, and it's a very timeless read, but a lot of people maybe outside our little world may not be familiar with it at all. But it's interesting that you not just hear that from the trend following crowd like we are, but even from someone who's certainly not known for being a trend follower, as far as I'm aware, that he would quote from that.
Like I said, everything in that book is real great, apart from the ending, I think, which is not covered in the book, if I remember that correctly, but I think Jesse Livermore, who's the character in that book, committed suicide at a later stage in his life.
Yeah, that's true. Other great treats this week, Jerry, that got a lot of love and attention?
Well, just to comment before I read another one, it reminds me of the Moneyball book. And when I read Moneyball, sure, and when I read Reminiscences, it's all about trend following. But then all of a sudden you see other people in other areas of investing, they try to adopt it as their own as well. So you would think that Moneyball and Reminiscences are only for us systematic trend followers, but nope. Other people in other industries or other areas of finance can figure out a way to make it sound like it's theirs as well. So that's fine. A follow-up tweet to that, which was the second most popular from the same article, quote, "It's all exactly the same. We can have the internet, we can have algorithms, we have robo-advisors, we have drones. You know what? It's all just human nature, and it hasn't changed. It's not going to." So sort of the same theme there, but I guess I have to say that it's in our best interest. We want this to be true. We're bombarded with trend following doesn't work, periods where it doesn't work well, and we just desperately need for human nature not to change, because we see that as a cornerstone of why trend following works. And so I do think it's in our self-interest and to believe that, and it's probably true that it hasn't changed. But I think we need to just recognize that that maybe it's not as objective. Maybe it will change. Maybe there is a way for the world to adopt automation, AI, machine learning systems to where it'll be very rare that human emotions and biases and human nature are allowed into the markets anymore to influence them. Kind of a downer, but I think it's just interesting. All of a sudden I get 5 likes, 10 likes, and then 50 and 350. And they all usually revolve around things we all want to be true.
Yeah. I mean, we were talking about this as well before we started, a little bit about when you look at the manager space today, right? There are some managers who really do trend following the way they did it back in the 80s, right? Or 90s. And it's very volatile, and usually those type of strategies are not favored by investors, so the AUM is small, but from time to time they deliver really, really strong returns, right when you need it, so to speak. But a lot of other managers, probably somewhat influenced a little bit, ourselves, is okay, so we evolve and we recognize the fact that outside influences such as investors' preferences, so we try to make it better. We try to have a higher Sharpe ratio and do different things to improve, because that's what people, quote unquote, want us to do and want to buy. But when you do that, there is obviously the risk that you lose some of the things that people really deep down want from us, which is what we're talking about right now. It's been a difficult year, and it may be the beginning of a difficult period for equities. And right now, what people really want is something that can make money for them in their portfolios as equities, and as bonds have done, previous in the year, have had a tough time. But it's that balance between staying true to what we probably know will work, but it just doesn't look as nice, while you're in it. And so people don't want to buy it. They only want it in selected periods. So that's the challenge. How do you bridge those two things?
We must stay vigilant. We must wait. We're preaching long term, so we need to be there when everybody starts to agree. Why did you change? Why weren't you there? And so that's, I think, even worse than living through a bad year or a bad period and being criticized, is when that opportunity comes. Hey, look, we did a great job in 2008. That was a crisis. 2008 itself. Can you imagine trying to debate and argue how did you do in 2018 prior to, the past few years? I provided crisis alpha. Well, that's strange because before October, there wasn't much of a crisis. Now, was there? No, there wasn't. So this is all in people's heads. Now, January 2008, the S&P hit a 200-day low. In January 2008, hit a 200-day low. What followed that was tremendous crisis because we trade a lot of different markets and we go short and we have a systematic approach. We did well. So that's the crisis. If we happen to do well in a bad month or week for stocks, great. But we just have to get it. We can't listen to this. We have to be ready. And when our opportunity arises, and we're not going to get a lot of love before that.
No. And hopefully people who believe in trend following like the three of us do, you take a little bit of comfort in your day from the fact that we are trying to help each other stay the course and not get too bogged down by a bad year or a bad month. Good stuff. Do you want to, are there any more tweets, Jerry, we should highlight before we take a couple of questions?
Yeah, let's do one more. Got a lot of likes. A week later, the same guy, Gunlatch again.
Okay.
People liked this. I believed everybody was intellectually objective and honest. I didn't understand why I couldn't convince people of almost mathematically analytical arguments regarding markets. After years, I realized people want to be told what to do, told what to think. And it just made me think of CTAs. We have these arguments, we have this math, we have these performance and track records, and no one wants to listen and believe in what we do. And it sounds frustrating. And then we're prone to say, well, we're not doing a good job of making this argument. No, we're doing a fine job. It's just that people can only handle what they can handle and believe what they can believe, and they're going to be heavily influenced by recent performance.
And to that point, Jerry, you know what they say? They say that a compelling offer is 10 times better than a convincing argument. And I think that's really what our industry as a whole have been trying to do for many years. We're trying to convince people that what we're doing is good for an overall portfolio. But I do think we need to maybe change a little bit and start thinking in the terms of how do we make the compelling offer instead? How do we phrase that? How do we talk about it? Now, of course, I've heard you often say, well, what do you don't like about trend following? Don't you like the diversification? Don't you like the discipline, the risk management? I mean, of course, people would say, yeah, no, I do like that. That does sound well. But it is, you're absolutely right. I mean, trying to convince people of something that they maybe not really are ready to believe is, that's a hard thing to do.
A follow-up to that was reminded me of some studies I've read that try to explain the performance of trend following and why it works. And one, I believe, was something goes along the lines that there's a delayed reaction. The fundamentals or the news is it's out, and it just people react in a delayed way that keeps the trends kind of going. And so he says here, there's this gap in time when people want to make sure they read it on some crawler somewhere that's telling them it's confirmed and it's safe and they're not going to be wrong alone. And then I followed up by saying a willingness to be wrong alone is an edge. And I think that has something to do with it as well, is that being wrong by investing in a lot of CTAs, boy, you're going to be alone. And that's not going to feel nearly as good as, well, all my buddies and I, we lost a lot of money last week in the stock market. And so that's just more comforting. And it's the whole idea of striking out and being willing to be alone and wrong in the short term is an edge that CTAs have, and anyone who trades systematically.
Yeah. Mohammed El-Arian gave a talk last year earlier this year, I think it was, at Context, and I've heard this quoted before, but he was talking about this thing about being, conventionally wrong is where people want to be rather than being unconventionally right, and it's that you're absolutely spot on. I mean, that is just something people are rarely willing to entertain, for sure. Any comments from your side, Moritz?
Well, I think you summed it all up perfectly.
Okay.
Conventionally wrong. I mean, I don't remember who exactly said that, but there was that quote, which I still have in my head in like September 2008 when Lehman defaulted. There was one person saying, if you made money in September of 2008, you were doing something wrong.
Right.
And then when you look at some of the records of the CTAs, they made a lot of money then.
We all did. So we must be doing something wrong.
Something wrong.
That's true. Right. Let's tackle a couple of questions. And here is one that, and I will, it's from Mohit, who has sent in quite a few questions. This is one that I have kicked a little bit to the side for a couple of weeks because, as I mentioned, Mohit, you want to know about moving average systems, position sizing, stops, etc. And actually, none of us really use moving average systems in within the firms we work with. So, but we're going to do our best, of course. We are up for a challenge. So who wants to kick the ball out and talk a little bit about, moving average as a strategy, as a way to do trend following, and the entry exit mechanisms, the stops, etc. Does anyone want to just kick off?
Well, maybe we can kick it off with a real simple idea, and then see how we go from there and become more detailed and complex as we go along, if need be. I mean,
go for it.
A popular indicator in the moving average space is the 200-day simple moving average. That's followed by a lot of people. A lot of people look at that. You can see the media writing about that indicator because it has been seen as providing support and resistance when you look at that on a chart level. But so in simple terms, how the strategy could work is to use the cross of the price. If price goes above the 200-day moving average, that would mean a long signal. And if the price goes below the 200-day moving average, that would be a short signal, or the exit signal for the existing long position. And then you could think about, well, if that long signal happens, say you're using closing prices or settlement prices, then you would initiate the position as of the next day's open or the next day's close. For instance, you would calculate a certain position size that you would attach to that position, which all of us believe should be a function of recent volatility and price fluctuation in that market, and then write that position until you have the exit hit. You can then become more complex, which we can continue to debate, but maybe we'll hear Jerry on that before we do that.
Yeah, I think using the moving averages are perfectly fine. They're highly correlated to breakouts. Recent articles talking bad about the 200-day moving average as it relates to the S&P 500 try to leave out obvious improvements to the 200-day moving average in order to prove their point that the 200-day moving average is not a good method. But in the public domain, there's so many good ideas. 50 crossing the 200, the golden cross. It's shocking how well that can work. I think that's a proper time frame for most of us, a longer term approach. You can stay in some long-term trends if you wait for the 50 to go above the 200 and then exit when the 50 goes below the 200. So it's out there. Its performance numbers are out there. It's shockingly good. I prefer breakouts versus the moving averages. Primarily, I think breakouts work better because they're harder. That moving average is so wonderful and nice that every day, every positive day in the uptrend, it gets a little bit closer. My moving average moves up closer. I'm locking in profits. The breakout is not as reliable. It is a stair step. Today's big move up, it may have no impact on the breakout exit at all. May not even move it. And so since that's very painful and things people really don't like about breakouts, they're probably better. So that sort of perversity pervades all of my trading ideas, that if it's hard, if it creates seemingly bigger drawdowns, then it's probably better. But yeah, they're fine. There's nothing wrong with moving averages. They're not better, probably too much worse than anything else.
Yeah, no, I agree with those thoughts as well. And Mohit, here's another way of thinking of how to build up a system using moving averages. So instead of just focusing on one moving average crossover, which, in fairness, some people do, and that might work well. But if you want to kind of diversify your entries a little bit, what you could do is you could do 4 different moving average crossover combinations, and you could give them each a weight of 1. So that means if they're all long, if all 4 of them have crossed to long positions, you would get a full score of 4. So each you give them a 1, so that means 4, and that means you have a full position. Clearly, if one of them then turns down and goes short, then you have 3 long and 1 short, so you have a net of 2. So that means you could be half long. And if 2 of them are short and 2 of them are long, you could be neutral. So it's a way for you to, and vice versa when it goes to the downside. So it's a way for you to scaling in and scaling out, because you ask about stops. Moving average systems usually don't use stops per se, because the stop is also usually a reversal when the moving average cross over to the other way around. So, but anyways, you combine 4 and gave them an equal weight, or you could have 8 and you give them an equal weight. You can kind of scale in and scale out, and I think that's generally something that we all believe is a good idea. You shouldn't rely on just one time frame and so on and so forth, because that can be tricky from time to time. You also asked about position sizing and correlation. I think that is probably something you have to look into on your own in terms of how much can you risk, because it depends on how many markets you trade, how much capital you trade, how much risk you're willing to take in terms of drawdowns. And correlations, there are different ways you can look at correlations, but one of the ways to do it, of course, if you built some kind of correlation matrix that is part of your risk management, then clearly correlations, based on markets or positions, could be relevant to some extent, or you can just choose a very well diversified portfolio of markets, and then by default, that is your, that's where you're happy with those markets. So you have some, less correlated markets in amongst them. So I think hopefully that's helpful. Mohit, thanks for your patience. And let's jump to a question here from Paul. And I think, Paul, we answered your first question or your second question last month, which was about, or last week, I should say, which is about whether we all trade the front month. And I think the answer to that was yes. But then you followed up with another question, and that goes to a comment that we made in an earlier episode about, in this case, it was Moritz, who works for a firm that is not considered as a CTA, and therefore the AUM that he manages doesn't show up in the CTA combined AUM, so to speak. And of course, what you're asking is, to what extent do we think there's a lot of investors out there, be that pension funds or insurance companies or whoever might have a lot of money under management, who utilizes trend following, yet the AUM does not show up in the trend following official $350 billion under management or so. So Moritz, Jerry, do you have any sense of how big the true space is, so to speak, if you broaden out the definition a bit to include end investors using trend following in some way, shape, or form?
Well, first of all, I think I need to make a correction about the front month markets. That'll be real quick. There's one category of markets where I'm not necessarily trading the front month only, and those are the short-term interest rates. So something
Of course,
like euro
yeah.
dollar and things like that.
Sure.
That may be 3 years out or something like that.
Yeah, true. Very true. Good point.
So that's just one.
And that's general. That's not just you, Moritz. Of course, that is
You probably as well.
something general in the CTA community that for when it comes to euro dollar, Euribor, short sterling, etc., you don't really trade the front month. It's too volatile.
Exactly.
Yeah.
Things like that. So just to have that 100% clear. As far as the internalization of trend following goes, that's happening. I mean, I've heard that certain pension funds, sovereign wealth funds, they do that. And I have no idea how to quantify that size.
Yeah.
Unfortunately, I'd like to know that myself.
Sure. But it's definitely out there, and it's probably not. Yeah, and it's probably not insignificant.
Yeah. And it's probably also safe to say that it's much larger than it used to be 10 years ago.
Yeah, because deep down, everybody's they're hidden trend followers. They don't like trend following per se, but they still do it, which is kind of fun in some respect. Any views on this, Jerry?
I have a different view. I mean, at the same time, one of my purposes in life in this podcast is to promote trend following. I really dislike hearing about so many people trend following. It'd be better if there weren't so many. The Eckhart article, great article, genius man. I was really happy that his average holding period is 8 days. I don't need someone that smart competing with me, and my average holding period might be close to a year. So I was happy about that. And I'm always wondering, when I hear about a new great trader, my first question is always, well, are they a long-term trend follower? And if the answer is no, I'm very happy about that. So I want people to like it, and I want that to mean more AUM for the three of us, especially, but don't like it too much and start doing it along with the three of us.
Yeah, that's a good point, Jerry. Now, John sends a question to us, which is more about some of the terms that we throw around in our conversations, and maybe we just talk a little bit about them. And some of them I'm not so sure we even use, but maybe we do have an opinion about it. So first of all, you talk a little bit about if we can just define alpha, and I think that's probably easily done. Alpha is usually associated with the outperformance that you deliver compared to your benchmark. And I think to some extent in the CTA space, I mean, you can argue that it's a little bit difficult perhaps to say what exactly is your benchmark. On the other hand, there are 3 or 4 that are often quoted, and I actually mention them in each week's episode when I go through the performance. But in our case, probably the one that comes closest is what's called the SocGen trend following index. And so anything we can do to deliver better returns than that, for example, would be considered alpha. Then you talk about crisis alpha and smart beta and implied volatility. Why don't you, Jerry, or Moritz, talk a little bit about those terms that we come across from time to time as well?
Yeah. So those were implied volatility, smart beta?
Smart beta and crisis alpha.
Okay. I think crisis alpha, we touched on that. What that means is the ability of especially ACTA to perform really well during periods of equity duress, right? Most people look at equities. We've said that earlier in this episode. So equities go down, your CTA performance goes up. And if that's the case, then that's equated to crisis alpha. Implied volatility, I'm not sure if we ever spoke about implied volatility, but volatility measures fluctuations. Implied volatility is the expected volatility of a certain instrument for a defined period of time in the future. So for instance, options, their value, is derived from implied volatilities. I'm not sure if we want to go into more detail there, but that is implied vol. And then smart beta, that is such a broad and difficult topic for me that I don't know if it's smart. I don't really know what it is. It is, I think, to the largest part, a very nice marketing term that firms came up with better ways of passive investing, passive long only investing, even by assigning different weights to stocks or instruments that are included in an index. So, for instance, weighting stock by sales or revenue numbers or all sorts of ratios as opposed to market capitalization. I think this is how it started. Whether that's smart or not, I don't know.
That's fair enough. Convexity is a word that comes up from time to time. Anyone want to comment on the word convexity? Some people use it more than others. I don't think we use it a lot, actually, but...
Convexity?
Yeah.
Okay. So convexity means that you have a nonlinear reaction to an event, right? So if, say, using options here again, options are nonlinear and therefore convex instruments in their behavior. You could buy a put option on the S&P 500, and if the S&P 500 then drops, say by 1, you could make a gain of larger than 1 from that option. So that is a convex behavior there, and the more the S&P then drops and the more that option becomes close to at the money or even in the money, the larger that reaction becomes. So there you have that increase in that reaction behavior, which is convex.
Yeah. Perfect. Now, Mohit sent another question, and that was regarding how to account for correlation while sizing the positions. We talked about that a little bit, but then you follow up, Mohit, with a question about whether looking at in the rearview mirror the analysis of correlation, whether that's fallible or not. Well, you can only look at correlations historically. We obviously don't know what the correlations will be going forward. So you have to find a time frame that you feel is not too long, so that it takes too long for these correlation changes to show up in your portfolio, but it's not too short that it seems to be moving around all the time, and therefore you keep changing your positions based on that. It's probably an area where you need to do. It's not an area where we can really give you a guide to how to incorporate correlations in your risk management. But there's, I'm sure, lots of things that have been written about it. So thanks for those questions. Anything else in terms of questions that you? Here's another one. Actually, here's another one from Dave. Rahi, and this is for you guys. He writes, with regards to your medium to long-term futures trading systems, what is the average duration time in the trade of your winners? Obviously, the losers take care of themselves, but I'm curious if they track the average duration, and they being you guys, in days, weeks, in terms of the winning month. So maybe you have a quick answer to that, Moritz and Jerry.
I'm longer term than almost anyone I've ever talked to, and I defend myself by saying I wouldn't do it if the numbers didn't justify it. I mean, we should all try to be as short term as possible. The drawdowns will be less, and that's the problem, was that what it takes to prevent that S&P drawdown getting short at the 50-day low or the 20-day low or whatever, parameter, it's not overall profitable. So I would love to be able to do that. Make more money, have fewer drawdowns, provide crisis alpha. But so I think a longer term holding period is wonderful. It works well for me. A year, I think another concept that I like is the philosophy of, I want to make it hard to get in and to the trade. I want to see some strong trend. And so I want to not do the trade unless it's kind of really powerful and strong. And then once I'm in, I need a compelling reason to get out. It hasn't moved in a month or two. No, it's just sitting there. That's fine. It's crashing. Yes. Now I'm starting to see a compelling reason that the trend is massively reversing. So that philosophy, I think, do nothing until it really looks like you should start doing something. It's great for commissions. It's great for slippage. It's also, I think, a good philosophy, and it led me to a longer term approach. What does it take to stay in? What parameter keeps me into these massive trends that last for a year or two, and yet I don't overstay and give back majority of the profits in a week or two. So this is, I think, the way to approach these issues. Look at charts, look at long-term trends, look at weekly charts. Does that fit your personality? Can you hang on? Are you strong enough to withstand those drawdowns that come with a 50 crossing the 250? Are you really serious about making big money in the big trends? Because that also comes with the big drawdowns.
Indeed. What about you, Moritz, in terms of winning trade duration?
Yeah, short answer on that. It's between 7 and 8 months, I believe, in that systematic trend following strategy. And everything that Jerry just said is 100% correct. I mean, I'm not trading that as long term as he does, even though I don't know the details, but by the sounds of it. But yeah, 7 to 8 months. If that trend continues, just like Jerry said, there's no reason to get out if the price just starts flatlining, just sitting there on a plateau. You have to have the patience to wait for that price to come down and hit your trading stop.
Sure. And I would say for our part, we're probably in between Moritz and Jerry in terms of we're certainly on the longer side as well. But it doesn't mean that we can't react more quickly to a reversal. As I mentioned earlier today, we have seen that this month in October, where we've gone, from being long to short overall equities. So we have some other ingredients in the model that allows us to do that from time to time, but certainly that's not doesn't happen that often. And on average, the winning trades are several months, as Moritz and Jerry indicated. Then we had a tweet to the three of us from Right Wick, I think it is from at Right Wick. Gentlemen, thank you for your excellent podcast series. Question: could you discuss, as much as proprietary allows, what goes into your backtesting system infrastructure? I'm programming backtest currently, and the topic is top of mind. So I can say from our point of view that we do all of this stuff in a system called MATLAB. So if you're familiar with that, that will mean something to you. I'm not a programmer, so I can't really give you much detail in terms of how it's set up, but we use that platform, and it seems to me that it has a lot of advantages. But of course, a lot of people program their own backtesting infrastructure, and as long as you have as long as you also know how to use or what kind of methodology to use for doing backtests, so you don't end up with everything being in sample, or then that is obviously some of the risks for overfitting parameters, etc. So, but anyway, that's how we do it. I don't know, Jerry or Moritz, if you have some comments about backtesting platform systems.
We use MATLAB as well. I'm a big proponent of Excel whenever possible, looking at long-term charts to get an idea of what works. I bought a copy of System Writer in 1988, which turned into TradeStation. Recommend, if you're not a programmer, to find a programmer who can program at least into TradeStation. There's a lot of packages out there. It's a big task. Entry, exit, markets, correlation, money management. It's a big task. We are where we are today after the three of us after 20 to 30 years. So it's a long project.
Yeah.
I've tried out many systems. As Jerry just said, TradeStation, I forgot the name it was called before it was called TradeStation, but TradeStation was a good start for me, it runs on a scripting language called Easy Language, which isn't too hard to learn, and it can do a lot of things. And just looking at my computer, it does have all sorts of software packages on it, which I've used over time. There's things like multi-charts, which runs on Power Language. There's things in R and MATLAB and Python. But also, like for the first tests, the first like idea generation, you come up with a thought that you think is interesting, that you really want to follow up on. Excel is just fantastic. And it's become so much better over the years. Like the 64-bit version of that is, if you have a powerful computer, is really, really good. You can do a lot of things. As far as daily operations are concerned, that, Excel may be a bit, not that great in that context, and you can use, more programmed tools for that. But, it's kind of like an assembly belt where there's a database in SQL and, it takes on data from data providers such as CSI or Bloomberg, and it can connect to a couple of those sources and then runs code and looks at accounts and does, produces orders and reconciles them. So it's a mix of things, Java, C#, things like that.
Great stuff. Good insight. I think that's probably it in terms of questions for this week. We do appreciate you coming up with great questions for us, and we will always attempt to answer them. So by all means, keep them coming. Send them to info@toptradersunplugged.com and put question in the subject line, and we'll be happy to try and tackle those. While maybe you think of some kind of closing points that we can bring up this week, let me just mention a little bit about the industry performance that we always talk about. So these numbers are again as of Thursday, so a couple of days ago, and we have not much changed actually from Thursday to Thursday, interestingly enough, but the BTOP 50 index, which is actually not the 50 largest, is more like the 20 largest CTAs, is down 2.63 for the month of October, down 5.15 for the year. SocGen CTA index down 3.17, down 6.52 for the year. The SocGen trend index, that is probably the one we track the most, is down 4.88, down 7.91 for the year. And the short-term traders index down 0.13% and up 0.25% this year. And then finally, the Bridge Alternatives Index, which is a flat fee fund index, is down 3.79, down 9.33 for the year. Any final thoughts, any final topics we should debate this week?
Happy trading next week.
Stay the course.
Stay the course. Absolutely. Well, on that note, we're going to wrap up this week's conversation. We hope you enjoyed it just as much as we enjoyed making them for you. And if you felt you did, please do share, and why not leave a rating and review on iTunes? It really does help promote this show. From Jerry, Moritz, and me, thank you so much. And we look forward to being back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.